Okay, hello everyone, and I'm recording now for workshop number 11. And in workshop number 11, we have the following questions. We have MCQs, which is part 1, and we have the case, which is the most important thing in part 2. Now, we will try to finish part 1 as easy as we can, and then we go to the second part. So the first part, the answer is there for students who are attending today. The answer is there, is just my comments are not there. I will try to upload these answers for you if you don't write them now or you don't capture them. But this is Basel 3, problem number 1. How much is the capital requirements? As actually Basel 3 came with 3 regulatory capitals. Common equity tier 1 7%, tier 1 8.5, and total capital is 8.5, and total capital is 10.5. Now, when we go to the next question, which is this is very important, because when we do credit risk, we are involved in derivative contracts. Now, this is OPS, some of them market related, which is the derivatives, and some of them are non-market related, like the LCs, the letter of credit, the letter of guarantees, all those contingencies and commitment. Now, let's talk about the market related, which is the derivative. When we are involved in derivatives, there is always changes in the prices in the market. And therefore, also the contract, for example, if we have a forward contract, which is maturing in 6 months' time, but there is always change in the market for the prices of the real assets, like interest rate. Therefore, the regulators want us to take to that consideration the current exposure, which means also we are not liquidating. They want us also to take care of that. So the potential, we have 2 exposures, one of them called potential exposure, and one of them called the current exposure. Now, the potential exposure is the normal one, and it is already telling us if we have a contract of such and such, the table will tell us how many years, and they will tell us how much we should account of that contract as a credit risk. But the current exposure, we have to see how we are doing in that, and we could be gaining in that contract called in the money, or losing in that contract called out of the money, and we have to count for it as 100%. So how do we define it? It's just the cost of replacing a derivative securities contract at today's prices. Means, please write here, if we settle today, this is the settling price. So if we settle, how much we will pay, how much we will gain. If we gain, then it's in the money and we have to count for it. And this is why I give you this note. Now let's go to the third question. This is interesting questions, and I already added to you this one. So in this question, we are talking about which pillar of Basel III Code requires quantitative disclosures for capital structure, capital adequacy, and risk exposure, so market participants are able to undertake a meaningful comparison of DIs and their risk-based performance. So if we are talking about quantitative disclosures, then we are talking actually, because this is on Pillar 3 already only provide information. Pillar 2 provide management, and this one is providing the quantitative. If we are talking about quantitative, we are talking about Pillar 1. But if we are talking about qualitative, we are talking about pillar 3, which is providing information. So for the sake of this question, and I will change it, it is actually, if this is quantitative, then we are talking about pillar 1. Please change it in your site as pillar 1, and I will change it in my records. So this is actually pillar 1. Okay, and you can see all those are the pillars. Okay, now let's go to the fourth question. Counterparty credit risk is the risk that other sides of the contract will default in payment obligation, whereby the other side is always the financial institution. No, counterparty, assuming this, what we called the derivative contract, the counterparty is the other party. So in this case, the problem with this question is this statement. The other party is always the financial institutions. No, the other party could not be the financial institution. So this is the problem with when we talk about the counterparty. So now if you are gaining in the contract, so if you are gaining in the contract, you have a counterparty who is possibly not fulfill the contract and will default. And therefore, this is why we call counterparty credit risk. Counterparty credit risk means somebody else, other party owes us, and he has to pay us either in maturity for that contract, for settling that contract. So the other side is not always the financial institutions. The other side is the counterparty. So when we talk about counterparty, is the other party who owes us. Let's go to the next question. Credit risk adjusted assets are on and off balance sheet assets whose values are adjusted for approximate credit risk. This is true. So risk, when we say risk adjusted, is actually, it's the different term for risk-weighted asset. So either you say risk adjusted, when we say risk adjusted, actually we mean risk-weighted. We mean risk-weighted assets. So whether you see it as risk-weighted assets or risk-adjusted, it's the same term. Number 6, in determining the risk-adjusted value of the on-balance sheet credit equivalent amounts of the contingent guarantee contracts, the risk weights are determined by the credit rating of the underlying counterparty of the off-balance sheet activity. That is right. So we usually go to, as we see it, as we are going to see it, we usually go to table 5. And in table 5, as you can see here, when we have any contract, whether that contract is on balance sheet or off balance sheet, the rating agencies, which is this one, Standard & Poor's, Moody's, or Fitch, provide the rating of the counterparty, whether it is a borrower or is it an issuer of bonds, or whether it is a counterparty in a derivative contract, or even a customer who is taking LC, letter of guarantee or letter of credit, whatever. So they will give us the rating of that one, and we usually use the Standard & Poor's, and this is actually the weights. So to answer this question, The answer is true. In determining the risk-adjusted value of on-balance sheet credit equivalent amounts of the contingent guarantee contracts, the risk weights are determined by the credit rating of the underlying counterparty My friends, please write this off balance sheet. So the answer is off balance sheet because we are talking here about guarantee. If you want this to be true, so this is off balance sheet. I don't know, 2 problems now out of order, but this is okay. Off balance sheet. Now we are whether we are talking about on balance sheet or off balance sheet or any contracts, there will be a counterparty. But because here we are talking about contingent guarantee, then we are talking about off balance sheet. Okay. Counterparty risk is the risk that the other, I think we have done this. So number 7 is Basel III introduced, maybe this is new for you, but Basel III actually different from Basel II because they introduced so many things. One of the most important thing is they increased this from 7%, from 4.5% to 7%. What we call the common equity, which is a concentration actually on the common equity, which is the quality capital. They increased the requirement. Basel II was 8%. This is 10.5%. They enhanced the area of the risk weights they change it for so many items. And the most important thing, actually, they provide 2 buffers. We don't have it before. And we call those buffers, according to the slides, conservation buffer and cyclical buffer. This we use it only, we use it all the time. And this one, this is already included in the ratios in the 10.5. This only regulators will introduce it. Introduce it when there is a need or a cycle, like a recession, much risk, like something like recession or something. If there is recession or changes in the economy and they are worried, banks may have no capital if there is a problem, recession or crisis, then the regulators will say, instead of the 10.5%, 50%, now increase the cyclical one and make it actually 13% because they add 2.5. And the most important thing also they provide, which we didn't cover, we heard about it, they provide something like liquidities. They provide some ratios for the liquidity that banks have to comply. And specifically, they talk about those 2 ratios. We didn't discuss it. We didn't cover it. But please understand that in addition to all these things, they provide those liquidity issues. So we are done with this. And now we are ready to go in this 1 hour, ready to go over the case. Now, the case or problem like this case, you may see it in the next test, or you may see it in any other, or maybe in the final test. in the final exam. Usually I have one problem for capital adequacy. See, the problem is if you not understanding how to do through, because you have to deal with tables and you have to deal with the tables and you have to understand the tables, and there is some technical things, but you have to exercise, you have to practice it. We have two problems. One problem in the tutorial, and we have done it, and Ovian, for those students who are not who didn't attend with me, he will cover it tomorrow. And also this case I'm covering in the workshop. Now in the workshop, we will go step by step. So I want you to upload this problem and put it in front of you in the desktop, whatever. And then we will go over the solution, and the solution is with you. And I will tell you the process. If you follow the process, then there will be no problem. There will be no problem. So I will try whether I can. So please upload the tables. You have to have the tables, which is this one. And these tables will be provided for you in any exam. You can access it, just keep it with you. There are 5 tables and you have to know how to use it. This is the standardized approach. So just to, hello? Are we okay? See, we have what we call, if you look, I explained this in my tutorial yesterday. When we want to calculate this capital adequacy and all these Basel issue is to calculate the pillars, which is pillar 1, which is this one, pillar 1, the risk-based assets. We are not talking about pillar 2 and pillar 3. This is information, and this is information pillar 3, and the banks has to provide it. It's all qualitative, and this is the regulators want to see whether there is good governance inside the bank. But when it comes to calculation, we are talking about pillar 1, and pillar 1 is only one formula, which is this one, this formula. Now this formula, whether we are talking about, it's the same formula. This formula is this formula, is this formula. However, the numerator is changing. Here we are talking about the common equity, tier 1, which has to be 7%. So you have to take only the common equity because we have 3 capitals, 1, 2, and 3. Now, common equity tier 1 is 1 capital, and we have to divide the risk-weighted assets of all of this. And tier 1 is another capital, which will be provided for you, and I will tell you how to get it. And you divide it by all those risk-weighted assets. Now, and then we have the total capital. And this one, we call it the standardized approach. So this is the standardized approach, which means standards according to tables. This one, we are using the VAR approach, and we are using some type of distributions, which means we are not using a number. We are making our predictions about the risk and the capital according to the normal distribution, sometimes of random behavior, like what we did in week 9. And this we are not covering in this unit. We just, I brought it to you in the slides. You can look at it at the end, but it's only talking about the VAR. So here, the problem with this one, the standardized, there is no problem, but the standardized, we have to calculate all those risks. We have to calculate risk-weighted assets for all those ones. So the tables are coming to calculate the risk-weighted assets for credit risk, market risk, operational risk, interest rate risk, and securitization risk. And this could be you know, a hassle if you, it could be some challenges if you are not really aware how to use the tables and to do all these things. As I told you, the formula is just a simple formula. What we have is, we are just dividing the capital over the risk-weighted asset. The capital will be given to you in the balance sheet. And this has to calculate it one by one using the tables. This is what we are doing. And you have to go through those steps. So step one, you have to calculate the risk-weighted assets. Number two, you have to calculate, because here you will calculate, you will extract the different capitals from the balance sheet, and then you will divide the capital by the risk-weighted asset to get the CAR, which is the capital, the three CARs. For equity, one CAR. For the tier one, another CAR, which is capital adequacy ratio. CAR stands for capital adequacy ratio. You have to calculate it. And then you have to check whether we are satisfying those ratios, the 7, 8.5, and 10%. This is the third step. If you are satisfying, the problem ends here and no more. But if you are not satisfying, which means you are not satisfying the 7%, 8.5, or 10.5, then you have to increase the capital. And we usually will increase the capital and check again whether we are satisfying. And usually, if we use the right method to increase the capital, which is we increase the equity, then you will test again and you will be satisfying and you will stop here. And this is the end of the problem. Fortunately, and good news here, when we are doing the case today, you have the case now, and we will follow this step by step. So this is the case, how you will look at it. So this is XYZ Bank. I give you the assets. This is the asset side. This is the asset side. Please write it. The on-balance sheet. And this is the liability side on the on-balance sheet. And all of this is the off-balance sheet. And then I give you another information about what we call the operating risk. And then I give you the other risk, but I use something called the capital charge. If you can calculate this and convert them, how much is the risk, then this is number one, which is the CAR, then you are done. You just test after that to step 4, step 2, step 3, and see you are satisfying. So let's work it together. Let's put this in a balance sheet. So we have 10 cash, you have fixed asset of 20, you have, as you can see, this is the 10 cash. I'm building just the balance sheet. And you have 20, which is the fixed assets. You have interbank, you have interbank with AAA, you will use this one. You have standard residential loans, which is this one, 70. And you have the business loan, which is 75. So I built this one. Now let me build the liabilities. They told me I have a deposit of 125. This is the 125. And I have long-term debt 50. And we have subordinated debt. What we are interested in, actually, in the problem for the capital adequacy, we are interested in these guys. These three. We are not interested in the rest, in the liability side. We just want to see the capital. We want to understand the capital and understand which capital is this. So this is standard debt because we will use this capital. So this capital, part of it is tier 1, part of it tier 2, and all of that is the total capital. So just to put this information here, we are not using this one, and we are not using this one. So this one actually, you can ignore when you do your problem. You can just ignore them. you will not use them. This will not be used. This will not be used. And you have to understand, subordinated debt is actually tier 2. And non-cumulative, you have, because we have cumulative and non-cumulative. So if it is non-cumulative, if it is cumulative, it is tier 2, which means it's like a debt. If you don't pay this year, you pay next year. But if it is, as it is here, non-cumulative, please be careful in the exam or in the test, whether it's cumulative or non-cumulative. It is non-cumulative, then it will become tier 1. And this is, we have 2 names for it. It's common equity tier 1, when we have common equity, but it's also, is also part of tier 1 capital. Tier 1 is a package. It has so many items here, but the basic item of it is the common equity. So you have to take this. So now if I ask you, what is the common equity? You can tell me, common equity is 10. And I tell you, what is tier 1? You have to add this and this. This will be tier 1. And if I tell you what is tier 2, you will tell me 4. Because this is tier 2. And now if I tell you what is the total capital, you will add this and this and this, and you can see it is 20. So total capital is actually, if you want to write it here, total capital we don't have, but we understand this is, all of this is now the total capital, which is actually 20. So I can say total capital is 20. Total capital is 20. Now, if you look at if you are following this step, actually I already finished this issue, step 2. I already have the capital, and the capital is divided for me. My problem is to calculate the risk-weighted asset, and this is what we are going to do. Now, when we calculate the risk-weighted assets, as you can see, according to the formula, we have to go for credit risk. Then we have to go for market risk. Then we have to go for operational risk. And then non-traded risk, non-traded interest rate risk. And then we have to go for discretization. Now, and we have to repeat this for the 3 capitals. Remember now, according to the formula, we have here how much? If you look, if you are going to do it, if you are, we have here 16 actually. We have 10 for the common equity. If you are going to do this, I understand that common equity is 10. And if you want the tier capital, it's 16. And this is, as you see, the total capital is actually 20. All I have to know now is just to calculate, as I told you this. This is repeated in all the 3 capitals. Okay. Now, when you do it, you have to start with this is where we have to use the tables. Please concentrate with me. This is where we have to, you start with credit risk. And the credit risk, the problem is we have 2 types. We have credit risk on balance sheet, and we have credit risk off balance sheet. The on-balance sheet is the easiest one. And by the way, when you calculate the credit risk according to the formula, most of the work in the credit risk, the rest is easier. So in the credit risk, we have, if I take you back here, for the balance sheet, for the on-balance sheet, we already know what is in the balance sheet. We already built it. Sometimes I will give you the balance sheet rating. So we have total assets of 20. If you look at the problem, what is the rating of this one? The rating of this one, they told me is AAA. Then I can you can put it here, AAA, but I can know this is AAA, and I can go for the AAA and find it from where? Oh, sorry. This is it's AAA according to the problem. So AAA now, I go to the tables, table 5. So all items, we have a counterparty for conversion. Table 5, AA is 20%. See, and I am using Standard & Poor's. Always use Standard & Poor's. I'm not using Moody's or Fitch. Please write this note. I'm using Standard & Poor's. So I go now to the, here, when I solve the problem, I know the rate is, the cash is 0, according to table 5. See, cash equivalent, any government securities, the credit risk is 0. This is cash, it's already in my hand as an asset. But the government is all not defaulting, so it's 0. And as I told you, AA, the A is 20. So I'll just go and do it very fast. So this is 0. This is the weight. And for the interbank, because it's AA, using 20%. And for the mortgage loans, we have to use, please write it here, table 1. And in table 1, as you can see, this is table 1. See, this is table 5. I go to table 1, which is for the housing loans. Which means now when you do on balance sheet, either use table 1 or table 5. So in table 1, they told me this is the LVR, which is the loan value to the value of the house. And I am using only this part. I am only using this part, which means the standard. I am not using the non-standard. Non-standard, please ignore it. So this one, I am only using this one, this area, this box. So in the exam, you can ignore the other one. So according to this problem now, what do we have? We have the LVR, as they say, the LVR 75%. And it is insured, non-insured. Non-insured. I will go to the tables. This is no insurance, and it is 75. So it's actually in this area from 60 to 80. So the 8 is 35%. So if I go now here, you will find that is 35%. Time the asset. So this is the equivalence, the risk-weighted assets, because I'm calculating now the risk-weighted assets. This is the risk-weighted assets. And then we have the business loans, which is 100. You can see it here. Business loans, it's BB, and it's 75. I go now to table 5. I will always use table 5, except for the housing loans. Now in table 5, the B is what? It's here, all the B's are here, which is 100%. This is the rating. So I use a risk weight or conversion of 100%. Then I go and I am done actually with the, so I use 100%. So I am done. And as you can see, the risk-weighted assets for credit risk on balance sheet is actually this number, 103.5. Now I am done with this. The problem is now I want to go for the, I have to go for the off-balance sheet. Now, off-balance sheet can be a little bit confusing. Remember, when we talked about off-balance sheet in week 9 and week 10, we talked about market-related and non-market-related. Market-related is the derivative contracts, and non-market-related is the other, contingencies like the letter of guarantees, performance-related standby letter of credits, and all those issues. Now, that's fine, but the problem is when we are using the tables for the off-balance sheet, Basel provide us with two sets of tables. If we are talking about the market-related, we have to use this table, table 2. Table 2, I give it already. As you can see, all of those, some type of contracts. This is derivative contracts, interest rate contracts, foreign exchange contracts, equity contracts. And I'm not using the rest for the problems, either in the test or in this example. I'm using only those contracts. Now, in these contracts, you have to understand something. You have to pick one thing, two things actually. The type of the contract and how many years. That's all. And come and take the rate. So if you look at this, for example, this is for the derivatives, which is I have to use table 2. Now for table 3, for the non-market related, which is the LCs and the guarantees, we have to use table 3 and 4. Table 3 and table 4. Because in table 4, we have the commitments and all these issues. And for the table 3, we have the contingencies. So just to recap, if we are talking about, this is the most confusing one in these problems of capital adequacy. If we are talking about the off-balance sheet, we have to see whether the asset is market-related or non-market related. If it is market-related, then it is a derivative contract, and we talk about table 2. If it is non-market related, then we use table 3 and 4. Let's go to the problem. So in addition, the bank have 50 million and performance-related standby letter of credit. This is non-market related standby letter of credit. Let's deal with this one. It's 50 million. And we will go to the problem and see they are talking about table 3. So it is 50 million. I know I just want to the weight, and the weight in table 3, if it is performance related contingencies, as it is mentioned in the problem, this one is the rate is 50%. So we understand now it is 50% at least in this case. So if we go to the problem of the off-balance sheet, we will find the standby letter of credit is the 50 million and the rate is 50. And the conversion is 50%. Now, please understand, when we do this off-balance sheet, there is another issue. We have to understand what we call CEA. CEA is actually the, you can write it there, but I will write it for you here. CEA stands for conversion equivalent asset. So we have to convert it first to, and then we take the risk weight. And then this will take it from table 5. The conversion we have to use If it is either you table 2, if it is market related, or table 3, if it is non-market related, and table 4, if it is non-market related. This you have to understand. And then after that, so this is the issue. So when we started with standby letter of credit, let's first calculate this guy. So it is, for the standby letter of credit is 25. We are done with the item number 1. Let's go to item number 2. 50 million in 2 years forward. It's already known, this is market related for derivative contract. 2 years forward Forex contract. So it's Forex and it's 2 years. So I will go to table 2. This is table 2. And I will look for the foreign, this is Forex contracts, and it's 2 years. So from 1 year to 5 years, this is 1 or less, this is 5, more 1, 5. So my friend is here. So, and it's Forex. So as you can see, it is this one. And it is in percentage. Remember, it is in percentage. It is 5%. So I will go and put it like 5%. It is this 5%. Now, as we discussed in the multiple choice questions a little bit, we talked about what? We talked about the current exposure and potential exposure. This is the potential exposure from the tables. The current exposures, you have to count it 100% if you are gaining in the contract. And if we are gaining in the contract, we call this in the money. This is gain. So if I look to the problem, 2 years forward contracts in the money, which means gaining contract. And it is 6 million. Just add it all. Just add the 6 million all. Put the 6 million. Now, do we have anything else? We have also 300 million in 6 years interest rate. Oh, so this is 300 million, that's fine. And it is 6 years. And it is market related. It's a swaps contract and for interest rate. So if I go to the tables, I have the interest, I have the exchange, I have the equities. I understand it's here. Now when I identify this, I need to identify how many years. They told me it is 6 years. So my friend is here, 1.5%. So I will go and put the 1.5% as potential exposure. I will see whether there is any current exposure. If the current exposure in the money, I will count it. Out of the money, you don't count it. This one, you don't count it. Okay, you don't count this. So I will put this here. According to the problem, they told me it is out of the money. I will ignore it. And it is 4 million. Just to confuse me or confuse you, I will not count it because it's out of the money, because it is out of the money. So because it's out of the money, I will not take it. And therefore, I am done, my friends. Just one more thing to do is, now I finished this issue, which is the most, technical one. I need to get the risk weights. And when I give the risk weights, I will tell you who is the counterparty on those contracts. Now, fortunately, in this problem, all the counterparty, it's one party we are dealing with, or maybe many parties, but all of them are actually in this rating, BBB. So when I need to do the risk weights for the CEA, I need to go to the table, which is table 5, and see the BBB, what is it? it is 100%. Triple B, according to Standard Poor's, is 100%. So I go and bought the 100%, and for all of them, I will put 100% for all of those, multiply them by 100%, and I will get this ones. Now I am done with the on-balance sheet, off-balance sheet, credit risk. And I am done from the old table, from this table, for the on-balance sheet. In the exam, if you manage to do this, actually, this is, most of the students have questions, have problems here. So I have now 141 for the credit risk. So risk-weighted asset is, I get it, which means if you look at this formula, I'm done with this guy, just the credit risk. I won't go into the market risk, operational risk, and all those risks. Now, the second one, which I didn't discuss this in the tutorial, we want to go to the operational risk. This is the operational risk. So the operational risk is the risks that coming from either from the system or from the people. And Basel were smart. They say, look, to count that, you cannot count it in 1 year. You have to count it over a few years because it's a behavior, either the systems or the people. And we will give you tables that are ready. We will give you a formula that is ready. So you have to use that formula and calculate the, so when we calculate the formula will be given to you. And the formula looks like this. This is the formula. So the formula is actually will give you retail banking. You just add the retail banking, commercial banking, and other businesses. This is what we do. Either we do commercial banking, or we do retail banking, or we do other services. Okay, all others. And you have, and they give you, and of course in the exam I will give you the numbers, and they will give it to you for the last 6 semi-annuals. 6 semi-annuals, which means this is year 1, year 2, year 3, the last 3 years. If you divide them semi-annuals, it's 6 periods. So, and I will give it for retail banking, commercial banking, and all other activities. As it is in the problem. In the exam, it will show like this. All you have to do is to apply the formula. So I will take this table completely. You can take it in the exam or you cannot take it, that's fine, as long as you calculate it. So as you can see, the thing that you will add is this one, and it's standard from the formula. So for retail banking, 12% times 0.35. For commercial banking, it's 15%, and other business is 18%, as you can see. Then so I'm taking this one, and this one. This is, you don't multiply by 3.5 for other businesses. This is how they design. Then you have to take this one, all of those for the retail banking, and just add them here. So this actually is this. Add them here. Do the same thing for this one. Do the same thing for this one. And do the same thing for this one. Which is this one. I'm just trying to get the color. So, and then you have to divide this by 6. This is 6 periods, and this they divide it by 3. This is how the formula comes. Then you will get what we call capital charge. Now we don't get risk-weighted assets, please. We get capital charge. Only operating risk, operation risk, produce for you capital charge, which means how much capital you need to meet this risk if it happens. They give you this capital charge, which is actually the 17.4. You can see it's in million. It's these amounts. To change it to risk-weighted assets, you have to multiply by this factor. Just multiply it by 9.52. Then you get the risk-weighted asset. For market risk, I am done. Operational risk, I am done with operational risk, and I hope you are following with me. Now I will go now to the other risks. So actually, if you look at it, I am done with this guy. Now, finish. I want to go to the additional information. They give me now capital charge for interest rate risk, market risk, and securitization risk, which is good thing. They told me you need 2 million. This is the capital charge, which means I have to multiply this to get like what I did, and I have to multiply it by 952. Of course, in the slides there is tables to calculate it. In the exam, it's very difficult to use those tables. So what I give you to complete the idea is capital charge. So I give you, multiply this by 9.52, this is the easiest actually. We are done almost. This 9.52, and we are done. If you look at the problems, how did I did it? This is what I did. I multiply the market risk 2 by 9.2. And as you can see now, I have all those risks with me now. Now I am in position, because all those risks are done. Huh? All of those risks now calculated. Just add them up. All of those risks now, as you can see, are actually calculated. I'm done. So I'll just go and add them up. I find this is the credit risk. This is the market risk, operational risk, IR, interest rate, and this is securitization. And I found that this is the total risk-weighted asset or risk-adjusted risk-weighted assets, whatever. Okay. Now I start now to do the verification. You remember we talked about steps, right? Actually, if you look at it, I am done with this step. I calculated this one and I have the capital. Now I just see the car, whether I satisfy or not satisfy. I calculate the car. So, and this is the easiest part actually. So I go and calculate the car. I calculate the car for the common equity, the tier 1, and the total capital. Unfortunately, I get only this, while I need actually 7% according to Basel. So I don't satisfy. I get only this, while I need 8.5, so I'm not satisfying. And I get only this. I am bad in all of them. I am not me. I mean this problem or this bank. So I'm not doing well in all of this. So now I have to increase the capital. Please write a note. As I talked to these students of my tutorials yesterday, all of you are my students actually, but we are talking about this. Obian will mention this tomorrow. When I have a problem of increasing, I will increase this common equity, because as you remember here, common equity this is how the capital looks like, huh? and I think I mentioned this, I'm sorry to repeat myself, this is how the capital looks like. This is how the capital, it's like a pyramid, okay? If I insert, this shape, for example, and I assume it's a pyramid, this part this area from this area is the common equity. And this area is tier 2. And this is actually, so this is common equity. This is the common equity, which we call it CTE1. This is what we call tier 1. This area is tier 1, and this area is tier 2. So actually, and this area, and all of this area, from here to here, all of this area is actually tier 1. So tier 1, this is the rest of tier 1. This is the rest of tier 1. This is rest of tier 1. And this is actually tier 2. And all of this is the capital. So tier 1 is this area from here to here. Tier 1 is actually from here to here. And tier 2 is this area. And all of it is total capital. So I add this and this and this and this. So when we talk about capital, if I increase this area by whatever, which is the common equity area, if I increase it, which is the base of this pyramid, everything above it will increase. So when I am short of capital, according to Basel, like what we are here, all I need to do is increase the common equity, and it will increase tier 1 and increase the total capital. So all of the capitals now, all the capitals will be increasing. So the question is how much I should increase it. I just increase it by 7, I make it 7%. So I take the risk-weighted assets, I multiply it by 7%, it's 14.3. And I used to have actually 10 from the balance sheet. So actually I increase it by 4.30. This 4.30 should be increased over the total capital and for tier 1, because all of them will increase with the same number. So in this case, as you can see, this is becoming 14.30. This becoming 20.30. It was 16 before, if you remember, it was 16. And this was 20. Now it becomes 24. This was 16. So actually I increase this one, this one, this one, and I test again. So this I get 7%. This now is 985 instead of the 776. This 1179 I'm satisfying. and actually I stop here. So I move to step this, then I increase the capital, then I checked again, and I satisfy, I stop. So actually I finished the 7 steps. So now I stopped here and I am done. Maybe you want to show the balance sheet or whatever. Now, after that, it's the same balance sheet. However, I just increased the equity. It's the same balance sheet which I have here. It's the same one. I just increased this by 4.30, which is the cash that received from the equity capital. And I increased because I issue capital for 430 and I received for that capital cash. So my balance sheet now looks this 1430 and this is 1430, and I am done with this problem. So my friends, any questions? I am done with the workshop of today. Do you have any questions? There is one question, sir. Can I have the attendance code? Okay, I give you the attendance code now. If there is nothing other than attendance code.